Fellow risk takers, this is your worst. Podcast host Andrew Stotz from A Stotz Academy, and today I'm continuing my discussions with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry deeply understands the world of academic research about investing and especially risk. And today we're going to discuss chapter 2 of his book, Enrich Your Future, the keys to successful investing. Chapter 2 is how markets set prices. Larry, take it away.
Yeah, this is something that is probably the most important thing investors need to learn before they invest a penny. Because otherwise you don't know whether the stock you're buying is undervalued, overvalued. You may have opinions, but you should really have a good understanding. How did the market get to that specific price? So you can then make maybe some judgment or choose to allow the market in its collective wisdom to make a judgment for you. Okay. So I searched for quite a while to come up with a way to have an analogy that people could relate to so they could understand this very difficult concept of how markets actually set prices. I feel pretty proud that I came up with this idea that almost everyone understands. And if you walk them through it enough, then they will understand how markets set prices. So the example I came up has to do with the world of sports betting. All right. So you could use this analogy to betting on soccer games today, which you could do on DraftKings and all kinds of websites, or football, or hockey, any sport you could think of, right? Horse racing, we could talk about that. Remind me, there's a good story about horse racing and betting as well. And we get to the Barber and Odin story about how individuals make stock selection decisions. So I decided basketball was a good one to use because there is some actual academic research on this. So the analogy I use is related to college basketball with Duke, which is a perennial contender for the national championship. Every year it's ranked in the top 25 at the start of the season. It has won a bunch of national championships. Now, at the start of every season, most college teams that are good try to schedule a few what are called cupcake games, just to give their players chances to get in the routine, learn the plays to run and get to know each other, etc., before they meet tougher competition. So Duke often scheduled a game against Army because they're, at the time, the most famous coach was a fellow named Mike Krzyzewski, otherwise known as Coach K. He had coached Army, and Army would travel down every year to Duke, and they would get a big payday, and Duke would have an easy win. So for people to bet on that game, no one in their right mind would bet on Army to win that game because they have played probably 30, 40 times already, and Duke has won every single game, and they could probably play another 30 or 40 times, and Duke would win every game. So how do people decide to entice people to bet on Army? Well, to make it an equal bet, they create what is called the point spread. So the bookies, today you might think of DraftKings or a Las Vegas casino or your local neighborhood bookie. They set the initial point spread where they think they can get an equal amount of money bet on both sides, because they don't want to make bets, they want to take bets. Okay, just like Merrill Lynch doesn't care if you make money or lose money on a stock you buy. Every time you trade, they're making money. They're a bookie. They just need you to trade, and that's an important thing to know. The racetrack doesn't care either. Okay. So the bookies do their analysis, and they think, based on historical events and the team's skill sets, that Army is likely to lose by 28 points. That's where they think an equal amount of money will come in. So the bookies set the initial spread, but they don't set the actual spread. That is determined by the bettors in their actions. So if a lot of money starts coming in betting on Duke, the bookies will raise the spread to 30, 33, 34 until money starts coming in on Army, until they get an equal amount of money. And then the winner has to put up maybe $110 to win 100. So if you win, you get your 110 back and you get their 100. But if you lose 110, not 100. So the bookies collect that $10 on the total of 200, each one betting 100 plus the 10. So that's their vigorish. Okay. So what happens is the point spread is moving based upon the collective wisdom of the markets. Now, it's very easy to determine, as we said earlier, whether Duke is going to win or not. Okay. But it's very hard, as it turns out, to beat that point spread. There was a study done on the NBA, the National Basketball Professional Leagues, 6 seasons. Okay. And they took the point spread. Let's say right now you have the New York Knicks are playing the Indiana Pacers in the second round of the NBA championships. Let's say the Knicks are favored by 3. Well, last night they won by something like 20. That would be an error of 17. Okay. And then let's say they had lost by 5. That would be an error of 8. And then you would average all the errors. Very rarely does the point spread actually predict the actual outcome. But it turns out, what is called an unbiased estimator of the outcome, because the evidence from that study in the NBA over 6 seasons, thousands of games, the average error from the point spread determined by a bunch of fans betting with their hearts, not their heads necessarily, rooting for the hometown team, or betting on Notre Dame because they watched the movie about Win One for the Gipper with Ronald Reagan, whatever it might be, right? And it turns out the average error was less than 1/4 of 1 point. So there's no way to exploit that information. I mentioned horse racing earlier, so we might as well touch on it here.
Well, before you go to that, just can I,
Yeah.
So what you've now shown is that the accuracy was exceptional.
Yep.
And the second point that you're making is that just the accuracy of the average was exceptional, but that there's also points, there's errors, but those errors are equally distributed. Like sometimes you're going to get it right, sometimes you're going to get it wrong. And so the existence of a winner or a loser, or the existence of even a big winner or a big loser, does not mean that it's not efficient.
Yep, that's exactly right. My mother used to love to go, God bless her, love to go to the racetrack. And she always bet on number 3 in the first race. Why? Because she had 3 children. If a jockey was wearing the color purple, she hated it. She wouldn't bet on it. She bet on because she liked the name of a horse. Now there are people who go to the racetrack, study the charts, study the form. Today they're seeing that the horses on the inside track or in the first or second position tend to win. So they'll bet on in the next races, they'll bet on that. They look at whether a horse runs better in the mud or on a hard track. Turns out that a 3-to-1 favorite, guess wins what percentage of the time? 1 out of every 4 races. A 30-to-1 favorite wins, a 30-to-1 underdog wins 1 out of 31 races. And these are people like my mother betting, on their hearts and other things, not because they're experts. But they did find one interesting thing. The big underdogs tend to pay off worse. People love to buy lottery tickets. So even though we know when you buy a lottery ticket in the US, the state takes about 50 cents of every dollar. So every time you buy a lottery ticket, your expected loss, the median is going to be 100%, right?
Right.
Most of the time you lose. But the mean is minus 50 cents, but people buy them anyway. Well, that's true with betting on horses. Turns out it's also true betting on stocks. Stocks in bankruptcy, 1% of them ever pay out to investors, yet they trade in indexes and people buy them. Stocks, small growth companies with high investment and low profits, they have returns worse than treasury bills. So there are a small groups of these lottery-like stocks that are inefficient because investors have such a strong preference, they overpay for them. And it's so expensive and risky to go short, as anyone who just saw what happened yesterday with GameStop and AMC. Just again, these stocks soared and punished the professionals who were short and maybe cost them billions of dollars again. So let's try to sum this up here to tie this. What does this all have to do with investing? All right. So Duke and Army, we said, was the great team and the weaker team. We have NVIDIA and Ford Motor. Which one is Duke and which one is Army?
NVIDIA, Duke.
Right. So it's easy to identify the better company. Why do people think it's easy to identify whether the stock will do better? The equivalent of the point spread is NVIDIA, I'm just making this up, might be trading at 70 times earnings, and Ford Motor is trading at 7 times earnings, and that's the equivalent of the point spread. On a risk-adjusted basis, they should be equal in their ability to provide investors with expected returns, or the market would price it differently. And we know that these PE ratios are unbiased predictors of future outcomes because active managers persistently fail. And I'll let you cite the evidence from the Famin French paper.
So just out of curiosity, I checked. NVIDIA is trading at 50 times PE and Ford is trading at 8 times PE. And so, and I just want to highlight what you've talked about here, because the first thing is that it's not so much that, we acknowledge that there's differences in those horses. And we acknowledge that a astute bettor will notice that, in the rain, this one, does better, or in the inside track, this one does better. Those differences exist. But it's the question is, are you the only one who has noticed these differences, or is it in the price?
Yeah, and we know the markets are not 100% efficient. And we know that there is these great risks of going short, so prices can get overvalued. It's unlikely to be undervalued because it's easy to correct that. You just buy the stock, but prices can get overvalued. Now, you have to remember, there are clearly people who know more about sports. If you and I might bet on college basketball, I think I likely know more than you. First of all, I lived in the US and college basketball is my personal love. I even played a little bit at a D3 school. But I'll watch games. Any good teams are playing, I don't have to have rooting interest. I'll watch them. And we know that people bet with their hearts sometimes and stuff. The thing is with stocks, you may have an advantage, more, a little bit more than others, when there are these inefficiencies. But is it enough to overcome your costs? You have bid offer spreads and you have some commissions. And if you're a big institutional investor, you're going to move the market when you're a buyer. And it's just like the bookies. They're taking, in the bookies, you have to be right about 53% of the time, not 51, but 53, because the bookies are taking that vigorous out of each bet. And at the racetrack, the state is taking in the US about 17%. So you have to be not just better than the average bettor, you have to be a lot smarter to overcome those costs. That's not even taking into account, Andrew, the time you're spending in doing that investigation instead of spending it with your wife or your grandchildren, reading a good book or other endeavors that might improve your
Or,
life.
yeah, or for instance, if you're still in the prime of your life, creating your wealth through business, is another part. One of the things I wanted to mention is that a lot of people will walk away from investing because they either lost big or they won big, and their experience with investing, let's say somebody wins big, and they'll take away more meaning than is actually in that. And so again, this unbiased estimator concept is so important, because in the end, what happens is that many people, like I see it all the time, where people say, yeah, but I have this friend who has a Lamborghini
Yeah.
that he got from investing in the stock market. So the stock market can't be efficient, Larry. Well, the unbiased estimator says, oh, absolutely. One person getting a Lamborghini out of the market is absolutely an outcome of an efficient market. We're not saying an efficient market does not say that there won't be extreme positive and negative outcomes. The efficient market says that that will be equally distributed on the plus and minus side. And therefore, when that guy goes back to make his next trade, he may lose his Lamborghini. And over his lifetime of trading, he's going to end up at zero if we don't include all the costs. That's a whole nother thing. But
Yeah.
do I have that right? Or is there anything more you
Yeah,
have?
that's basically right. I'll add a couple of little caveats here. We know from the evidence that on average, retail investors are naive or dumb money, and institutional investors who are much more aware of the academic research are smart money. Now, here's the thing. So I mentioned earlier, there are a bunch of stocks that have certain traits or characteristics. I call them lottery stocks that have very poor returns. And we know that value stocks over the long term have outperformed growth stocks, and smaller stocks have outperformed large stocks, and quality or more profitable companies have outperformed. Guess which side of the trade the naive retail investors are on? And since somebody is a buyer, someone is a seller also. And so if you look at portfolios, the retail investors tend to be overweight the stocks with poor characteristics, and the institutions tend to slightly overweight. The problem is only 10% of the trading is done by individuals today on their own, as opposed to individuals owning mutual funds or ETFs run by institutions. So there just aren't enough dummies to exploit for the active managers to win persistently.
Mm-hmm. So that
So
this research you cited about from Brad Barber and Terrence Odine talks about many. They've done a lot of different great research about the behavior of individual investors, performance of men versus women, and also investment clubs and all that. Maybe you could just summarize what is the outcome that they found through their research.
yeah, well, number one is that we know an all too human characteristic is overconfidence. We tend to be overconfident about all kinds of things. There have been studies done on asking people if you're a better than average driver. 90% of the people say they're better than average, which by definition is impossible, right? But the more interesting thing is they did a study asking people who were in hospitals involved in car crashes where they were identified as the cause of the accident, and they still said they were a better than average driver. It showed, right? Now, overconfidence is probably a good thing in our daily lives, because if we looked in the mirror and said, gee, I'm dumb, ugly, stupid, and nobody likes me, the suicide rate would be pretty high. So we tend to feel good. We think we're good looking, everyone likes us, and that helps us get through life with a better attitude. But if you're overconfident about your stock picking, what are you likely to do? One, you won't diversify, because I don't need to diversify. I can figure out just a few stocks, right? And you'll own the riskiest stocks because you know they're not risky. The
Mm.
market is stupid, and you're a lot smarter, right? So you will concentrate, and that's how, let's say there's 100 stocks with lousy characteristics, and 100 different people buy each one of them, one for each one. Well, one of them ends up with the Lamborghini and the other 99 are bankrupt. That's your example. Didn't mean that the guy who got the Lamborghini was a genius. He got lucky. Of course, he will attribute it to skill, and the 99 will attribute it to what? Bad luck. Not right, until they eventually have enough losses that maybe they wake up and read my book and read the evidence and say, I think I ought to stop playing that loser's game, right? And accept market returns because I'm not smarter. And I have to learn whatever I think I know about the market. I just ask the question Larry taught me to ask, which is, okay, I know these things, but am I the only one who knows it? Does Warren Buffett not know it? Do all these hedge funds not know it? And if they do, it surely is in the price, and therefore it's too late. I should ignore it.
And one of the questions I had about the Barber and Odin research was that, their research was done a while ago, and they did a lot of research on individual investors, when you could say individual investors probably had more stocks and less, let's say, global or broad-based ETFs and stuff. And when you're looking at a person's portfolio and looking at the number of stocks that they own, and let's say we go back in time and 30 years ago, they own 3 stocks, but now they may own 3 stocks plus S&P 500 index. Does that change the way that a researcher should look at whether a person is diversified or not?
Yeah, certainly, but it would depend if 90% of your portfolio is in the 3 stocks and 10 in the S&P, you're not diversified. Well, if 90% is in the S&P and 3 in the 3 stocks, well, maybe that's your play money. There's a couple other things we can talk about that I think are amusing stories, but provide insights. Brad Barber and Terence O'Dean also did a study on men and women called it Boys Will Be Boys. And they looked at, did men or women have better outcomes? Or let me ask this first question. Were men or women better stock pickers? What do you think, Andrew?
I think men are better stock pickers, of course, because I'm a
No,
man.
neither was a good stock picker. They both, the stocks men and women bought tended to underperform after they bought them, and the stocks that men and women sold tended to outperform after they sold them. Of course, no one will ever admit that, right? They'll only tell you the positive story and never the other ones. But here's an interesting story. Both had equally bad stock picking skills and market timing skills.
Which makes sense because the market's efficient.
Which, exactly right.
Yep.
It's just as efficient for men as it is for women. But it turns out that women actually had better returns than men. Why was that?
Risk, their assessment of risk.
Nope, wasn't that. They traded less.
They traded less, right?
Why did men trade more? It's that testosterone
Confidence.
factor, because they were overconfident, traded more. So men have confidence in skills they don't have. Women know better, right? And here's the last question on that one. Who does better, married men or single men?
Married men, of course.
Yeah, the women tempered their husband's enthusiasm or over. Who did better, married women or single women?
That I don't remember.
Single women,
Okay.
right? Because the husbands would screw them. Here's my last story on this.
So wait a minute, Larry, if I get married, that means I'm going to have better returns?
Yeah, probably.
Now that is a good argument for getting married. No, just kidding.
So here's my last story on this subject. you would think if any group of investors would outperform, it's the Mensa Investment Club, right? Because clearly, these are by definition the smartest people on the planet. I think it's if I remember correctly, top 2% by IQ.
So that just so everybody understands, when you get together with a group of people to decide, hey, why don't we share our knowledge and discuss about stocks and, really work at this and try to, focus some time on it. Two heads are better than one, as we say
Not,
in America.
yeah, not when it comes to investing. There's all kinds of study on investment clubs. All they underperform, and which is expected because, right, the market is efficient. But the Mensa Club set a record. One guy talked about, he lost something like 72% of the asset in the club over the 30. Their returns were worse than T-bills and that kind of stuff. It was just her. I forgot the exact details there, but the results were terrible.
They
And
trail the
it
market.
shows you that intelligence is not enough because the game is not one-on-one. Warren Buffett has not been able to outperform the market in almost 20 years. He's clearly a smart investor, but the game is a collective wisdom of the entire market you're pitting your knowledge against. And that means it's a very different game than one-on-one, which is the subject of the next chapter in the book. Why do we see persistence in the performance of athletes, but not for money managers? And so I try to provide an analogy, and I guess we'll do that in our next session.
And one other thing that's interesting is that many people in the stock market who are somewhat beginners and they start buying stocks, they really don't know what to do. So they end up just holding, let's say they buy 3 or 4 stocks, they're under diversified, and then they just hold them. And when they look at their friends or other people that they see trading in the market who are constantly telling them about how they bought this, then they sold that, then they bought this, and then they're trading a lot, this research showed that actually what happens is the people who are trading a lot underperform the people who are trading less. This is for individual investors, let's say retail investors, by about 10%.
Yeah, it
That was an
shocking
amazing.
how bad. It's even worse than that in a related story to that. Well, it should be expected. The more you trade, you're incurring trading costs, right? Bid offer spreads, for example. If you buy even ETFs and trade them, spreads between the bid and offer can be significant. Even if you think it's commissionless trading, as they say, BS. Yeah, there's no commission, but you could pay a bit, and you're never going to get an efficient price because the market you'll buy above the NAV and you're going to sell it below the NAV because the arbitrageurs will be on the other side. Okay. And so you're always going to lose a little bit. Now, it may be a very minor number in things like an S&P 500 index ETF, but in a small cap and emerging markets, sector funds, the spreads can be quite wide. And that is especially true in markets where it's moving rapidly because there's news coming out, after a GNP report or an inflation number, the spreads can actually get very wide. There's a problem there.
There's 2 last research papers that you cite in this chapter. The first one is Fama and French talking about they found that only managers in the 98th and 99th percentiles showed evidence of statistically significant skill. And the other one was similar results were found by Philip Myers-Braun and his study, Mutual Fund Performance Through a 5-Factor Lens. Importantly, the research consistently finds that there is no persistence in performance beyond the randomly expected. Can you just wrap up this discussion? I mean, Fama and French is, a seminal research that's being done there. It in theory, it should have decimated the industry. And you can say it did to some extent where passive funds became now almost 50% of the overall industry, but maybe you could just talk briefly about those.
So let's go back when I wrote my first book in 98. At that time, Charles Ellis wrote a much more famous book, Winning the Loser's Game. And he found about, on a pre-tax basis, 20% of active funds were outperforming their benchmark. After taxes is probably 10%. That's still a big time loser's game, especially for taxable investors. I don't like playing games where there's a 90% chance of losing. Fama and French then come along 12 years later, and the market had become much more efficient over that time because of published research showing that there are certain types of stocks that have characteristics of higher returns. And now you can't claim alpha because you're buying stocks that are more profitable or with momentum and things like that. Before that, there was no research, so you could claim alphas, no more. So this is the subject of, Warren Buffett. How did he beat the market? We know today it's not because of stock picking, but 60 years before the academics discovered things, he figured out what are the characteristics of stocks you want to buy, and even told people, buy cheap, high quality, profitable companies. All right. So that means value stocks that are profitable, don't have a lot of financial or operating leverage, and you will outperform. Okay. So Fama and French found that took less than 2%, and that has been duplicated. Now, randomly, over a long period of time, if you just flip coins, for example, did it 10 times, somebody out of 1,000 people will flip 10 heads in a row, or some group of people will do it. But that doesn't mean they're a skillful, you say the heads flips win, that doesn't mean they're skillful. We randomly should expect, right? We have 10,000 people. After one round, you have 5,000, 2 rounds, 2,500, 3 rounds, 12, 15, etc. And maybe you have 10 winners after 10 rounds. Well, you're not going to bet on them to win the next round. The only way you would do it if you found that there were like 100 of these people. Maybe there was a skill in flipping the coin, or the coin wasn't fair, right? Well, Fama and French found the actual number was less than you would randomly expect.
So explain that for a second,
problem.
because what you say is Fama and French found that only managers in the 98th and 99th percentile show evidence of satisfactory,
statistically significant.
What would it have been? What would
about the same number? Let's say maybe
Okay.
we would expect 2 or 3%, right?
Okay.
So there was no difference, right? You would expect in any one year 50% if the markets are before costs. 50% should beat the market. After 2 years, then it should be 25%. You beat 2 years in a row, and then 12%, 6.5%, 3%, etc. Right? And they found that's what you should expect randomly once you adjust for these factor exposures. And S&P has reported the same thing. They just came out with their 2023 SPIVA report, and I scanned it through, and basically, if you just read the headlines, it says fewer than the randomly expected number of active managers repeated in the top quintile in the last 5 years, or whatever they looked at, right? And stuff. So that's the problem. Let me add one other thing I was going to mention. We mentioned the more you trade, the worse you tend to do. Okay. The researchers found the more you look at the value of your portfolio, the worse you do. Why is that, Andrew?
Because you're going to trade more.
There's only 2 things you could do when you look at your portfolio. Do nothing, or it could cause you to act. Well, if it causes you to act, acting is bad because you have more costs. You're better off being a Rip Van Winkle investor. Just be globally diversified, use low-cost passive factor-based funds, and you will likely outperform the vast, vast majority of professionals if you have the discipline to stay the course and rebalance along the way. So you're better off being a Rip Van Winkle investor and not don't watch Kramer on CNBC. Don't listen to what these have to say. They don't know anything more than the market is already priced in.
And just one last thing that I want to highlight is the factor-based analysis that was developed by Fama and French originally, I think, were the ones that brought a group of factors, the three factors together. Basically, if I understand it correctly, from that moment on, no one could then claim, it would be harder to claim outperformance, because basically what you could then do is you could say, well, wait a minute, small cap companies outperformed during that period, and you were overweight in small cap companies. And I could have gotten that exposure either by building a portfolio of small cap companies, or I could have bought a small cap fund or ETF to get that exposure. And how does that all come together in the way we think about it now?
Let me think of, I can explain it, add a little bit to
Mm.
be helpful here. So prior to Fama and French publishing their famous paper, the cross section of expected returns, if you bought value stocks, there was no model other than the CAPM, the capital asset pricing model, which was a single factor market beta factor, which is close to think of it as volatility relative to the market's volatility. So if you bought cheap stocks, value companies, low PE, low price to book, low price to cash flow, and you beat the S&P 500, that was alpha. You could claim you outperformed. After 98 or after 92, 3, when that was published, you can't do it anymore. You could claim it, but a researcher will say, well, let me run your portfolio through my factor model. We'll say, will account for your exposure to these value stocks. And now if you show excess returns, then you're a skillful stock picker. If not, then you were just loading up on these factors. So those factors were explaining like 92% of the variation in return. So explain the vast majority. Different. Today we're up to like 98% because we have a few other factors there. But let me add one thing just to clarify your point. So if you bought small stocks and over the long term, small stocks outperform, you can't claim it anymore. You could before 92.3. But if you bought an overweighted small stocks when they were outperforming and underweighted them when they were underperforming, then you could claim skill, right? Because you had different weightings at the right times. So your exposure varied at the right times. That would show skill. But we don't find evidence of that. That's the problem. We don't find evidence that people shifting their strategies and exposures
And this is market timing.
them. That would be market timing, yes.
Okay.
Their factor exposures may change, but they don't change at the right times.
And ladies and gentlemen, that is how markets set prices. Larry, I want to thank you again for another great discussion about creating, growing, and protecting your wealth. And for listeners out there who want to keep up with what Larry is doing, find him on Twitter at Larry Swedroe and also on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.